In this market update, I'm going to talk about why invest in fixed income, plus also what area of the market we see in fixed income that is a concern. Hi, Jim Gore from THOR Wealth Management. In this market update, I'm going to talk about why you invest in fixed income and what parts of the fixed income market are a concern at this juncture. And this chart here from JP Morgan is a really good chart. It looks at the drawdown that you're getting from fixed income. This is looking at the aggregate bond index. And if you look at this over the last 49 years, the biggest drawdown was in 2022. During the intra-year, it was down 17%. That's significantly more than it has historically been. Historically, in any given year, you would expect a drawdown of 3.5%. So bonds are not always safe from a market standpoint. You should expect to see some drawdown during the year. As I said, it's 3.5%. But 90% of the time over the last 49 years, the bond market has been positive. So that's one way of looking at risk, is how big of a drawdown. We think permanent loss of capital is something that should be the bigger risk that you should look at. But in this case, this is volatility, and this is why people want fixed income in their portfolio, is for less volatility, but also getting that income stream. Now, compare that to the equity market. If you look at this chart here, you can see that the equity market in any given year over the last 45 years, the drawdown has been a little bit over 14%. So it's 4 times more than bonds. And you can see the big drawdown was back in 2008 when intra-year was down 49%. So in the equity market, you have a lot more volatility than you have in the fixed income market. It's 4 times more drawdown on average. So you should expect, 14% drawdown any given year. And, it's up 75% of time. So once every 4 years, you should expect to see a negative return in the equity market. So in the fixed income market, what should be my expected rate of return over the next 5 years? And we find this chart very helpful because if you look at the yield, whatever the yield was over the next 5 years, that's really what your return is. So right now you're getting a yield of about 5%. So your expectations on the fixed income market should be 5%. Now, when we did our market update for the THOR dexes back in January, the first one we did this year, we were talking about fixed income as more attractive than the equity market. Why is that? Well, if you look at the rate of return, the expectations for the equity market over the next 10 years is 5.7%. Fixed income, it's 5% over the next 5 years, but you have less volatility. And you have to take in volatility in your portfolio. If I'm getting a rate of return of 6% with a lot of downturns and years down 14, 15%, where I'm getting 5% with no drawdowns or very little drawdowns, that's significantly better. And that's why we like fixed income more at this juncture than the equity market. And that's why we have fixed income as part of our 100% equity portfolios. Now, what areas of the market do we find unattractive in the fixed income market? And that's really the high yield space, and specifically one area that I'll talk about at the end of the video. High yield spreads over treasuries over the last 25 years are the lowest they've ever been. You're looking at a spread of only 2%. If I'm buying a bond that has a risk of going into default, I should expect a higher rate of return on my investment. And historically, right now, we're 2.5% below the average. So what does that mean? That means that if that spread narrows, there's 2 ways it can narrow. Treasury yields come down, so you make money on other bonds and high yield bonds remain the same in the price, or you have the price of high yield bonds go down and that spread widens. And if that happens, you're going to actually see some losses on high yield bonds compared to the rest of the market. So we find the high yield sector, and here again, just looking at the risk here is that spread is going to expand to where it has historically been. And when that happens, high yield bonds will underperform. Another way of looking at high yield bonds, and this is something that is just doesn't make sense whatsoever. Banks have their prime rate for loans. These are the best customers. Right now, that rate is 1.5% higher than junk bonds. So that means that, people are buying bonds and banks aren't lending out to their best customers. They're getting a higher rate than you are buying these junk bonds. So if you own junk bonds, you want to own very short-term high yield instruments in your portfolio. The one area going because the high yield is unattractive that gives us really major concerns is private credit. It is being sold by everyone. It seems like everyone is coming up with private credit funds. They look good when all the money's coming in. The biggest concern is liquidity. Good luck trying to sell some of these bonds that you own or loans that you own in private institutions when money starts drying up from that. You can see those spreads really blow out, and it's a real big risk to the fixed income market. I hope everyone has a great couple of weeks. As always, if you have any questions or concerns, give us a call or reach out to us at our website, thorwealthmanagement.com. Take care. Subscribe to the Thor channel today.